Hi everyone, it's Alex here at Sestrin Capital Research. Welcome to our Inner Circle webinar. It's currently Monday, the 18th of March, 4:15 Eastern for the benefit of the tape. Okay, so today I want to run through each of the market indices as usual. So the S&P, the Nasdaq, the Dow, the Russell. We have it's sort of an easy time in the market right now. So we had quarterly options expiry last week, Friday. We have FOMC starting tomorrow, Tuesday, and reporting Wednesday when Powell will give the press conference. And market is a little unsettled between those two events. So we'll take a look at what's happening in the indices. A couple of earnings reviews. I want to look at two stocks we don't spend a lot of time on, Apple and Adobe. Interesting moves at both of those names, I think. And then semiconductor continuing to be the topic of the day. I want to look at Nvidia, Taiwan Semiconductor, the three ETFs being SMH, SOXX, and SOXL, and also take a look at Meta as well, which continues to defy gravity. As always, we'll do live Q&A, and so format, let's get the index review session done, and we'll stop for questions, and then as always, open mic basis. And if you don't like to or you can't use audio, you can use a Slack system, the Inner Circle Slack channel, or failing that, use the question function or the comment function here in the webinar platform, all of which are fine, and I can read out for everyone else's benefit. Okay, before we do any of that, let's do our standard disclaimer, which is on your screen right now. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Sestrin Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Sestrin Capital Research. Sestrin Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's do index review. Let's get this on your screen right now. 1 second. So let's do larger and shorter degree. Let's do the S&P first. Okay, so this is the SPY ETF. And this here is our bull case. So this is a long run chart, daily chart that starts at the COVID lows where SPY hit 208, that's around 2200 on the SPX. Put in a wave one up at the end of 2021, early 22 at SPY 480, about SPX 4800, and a wave two low in October 22 was the bear market low at 350 on the SPY and called it 3500 on SPX. Now, if this chart's correct, in other words, if that's the correct trade point zero, this looks like a good wave two retrace, a 0.5 retrace, which in a bullish market cycle is a reasonable wave two, seen deeper, but it's okay. Then if true, we're in a wave three up. We're probably about halfway up the wave three. Wave three in an index like the S&P, you wouldn't expect it to stretch much further than a 1.608 extension. Anything's possible, of course, but don't think you'd expect it. And in which case, that resistance might happen at around 770. We're currently at around 510 from a low of 350. So we've put in about 160 up. And if you said that we're about halfway up this potential wave three, that would feel about right. The alternative view on a long-term basis is that we are instead in this 5-wave up base case that started back in the 2016 lows. If you remember, before the new administration in 2016 took hold, it sold off into February before expansionist policies drove the markets up. And we got a wave one up into the pre-COVID highs, a 78.6 retraced down to the COVID crisis low. That's a really good wave two. That's a high confidence wave two. We got a 1.618 wave three up into the 21-22 highs and a 0.5 wave four low into the bear market lows, and then we're in this wave five up. And so the unknown to me, at least, is which of these is true. Are we in the final stages of a fifth wave up of a 5-wave cycle that started back in 2016? And you can see just technically why that might be the case. Or are we halfway up a wave 3 of a 5-wave cycle that started in 2020? Now, getting this wrong, and where SPY goes, the same is true of the Nasdaq. It's a bit less true for the Dow, and it's a lot less true for the IWM, but for the Russell 2000. But SPY and the S&P and the Nasdaq, pretty similar calls. So if we're in this wave 3 up, then the stupidest thing anyone could do is bail out at this point and miss all these potential gains here. But if we're in this wave 5 up, then it's getting time for the market to top out and put in a major reversal down. And I personally have no evidence as to which one of these is it. And so to me, you just have to keep watching. Short term, there's a fair bit of worry, I would say, which doesn't mean, you see my trades, I'm not running for the door, but I'm just a little bit concerned about a couple of things. So here is the ES futures, which is a similar chart to the SPX index. This is a shorter term cycle. Here's the bear market low, October 22. Here's a wave 1 up, green wave up into December 22, green wave 2 down, December 22 lows. And we've been in this giant green wave 3 up, and we're in the purple wave 3 of this green wave 3 up. And we're at a 3.618 extension of this prior wave 1 placed at that wave 2 low. That's a big extension. And so far, we zoom in, the S&P is not pushing through that extension. This is what a topping cycle looks like. Now, don't suggest it's going to dump tomorrow, but I do say that is consolidation in a zone where you have a clear technical high, a 3.618 extension, and it can't push through. And it's tried. This is a daily chart on the 8th of March, 12th, 13th, 14th, 15th, 18th. So it's tried for a week or so, plus a week plus now to push through, and it can't. Now that to me is indicative of a potential, at least short-term sell-off. And if we get a short-term sell-off, the level I would be looking to is 4,800 on the ES, on the SPX, that's 480 on the SPY. Why? Because that's a retest of the 2021 all-time highs, which were an important level. You can see back in this zone here that the market, this is back in December last year, was trying to push through that 2021 high and couldn't for a while, but then it did. So the caution with these things is, this feels a bit to me like markets did in 2020 and 21, when they'd run away with themselves, and whenever they paused for breath, you thought they were going to roll over because they'd moved up so much, how could they keep moving up? And the only mistake really was to be too cautious. And that was also true in 2023. The only mistake you can make in 23, and the only mistake you can make in 24 really so far, was to be too cautious, too bearish. So that this is a potential topping pattern here doesn't cause me to be running for the door and shorting and all of that, but it does cause me to be a bit concerned. And so if you're watching trade alerts today, I sold a few things. I took small profits on UPRO, that's the 3 times long S&P ETF. I didn't have a big stake in that. I sold out at just a bit above break even on UDOW, which is the 3 times long Dow. And all of that is just to reduce exposure heading into FOMC. If the S&P rolls over and starts heading for 4,800, we'll know. That won't take anybody by surprise. It's not going to sneak up on you. You'll see it. And at that point, that might be time to add some hedges or some naked short positions, I don't know. But right now, I've just flagged this concern here. Now, I would also say, back to this, the only mistake in 23 and 24 has been to be too cautious, is this wave 3 here, this green wave 3 here, can easily get to 55.80, and that would only be the 2.618 extension of its prior wave 1 here. You have to always think in multiple time frames, multiple different waveforms when you're doing this sort of analysis. So there's nothing scary about the idea that the S&P could get to 55.80 or beyond. The question to me is not does it get there? I think it will. The question is there going to be a sell-off before it does? And if it is it going to be a deep sell-off? Because, you know, from July 23 down to October 23, that was quite a dump. So July 23 high, 46.40, October 23 low, 41.14, and it felt bad, right? It felt very bearish. So this is my main chart focus right now. If we look at the Nasdaq, I think the S&P is leading the charge here. In the Nasdaq, we are right in the middle of the base case wave 5 termination zone. So again, in this base case view, this would be the lows that started at the end of 2018, wave 1 up, 2 down into the COVID lows, a 3 up into the 2021 highs, a 4 down into the bear market lows, and then this 5 wave up now that should finish somewhere between 420 and 465. And that's exactly where you can see this little zone of weakness now. So there's every argument that says, well, this is it, it's done, the Nasdaq's pretty much peaked and it's going to roll over. I don't believe that. I think it has further to run, but you can see that it's struggling here. An alternative argument says you start at the COVID lows, put in a wave 1 high into the end of 2021, a wave 2 low into the bear market low of 22, and again, we're about halfway up into this wave 3 up that could reach 650 on the QQQ. As I've said for months, getting this call wrong will be expensive. If you think it's going to go up here to the moon and you hold and it sells off, that's going to be expensive. If you think it's going to dump here and you sell and it goes to the moon, that's going to be expensive. So this is really important to get right. Both of these are equally viable technical analysis patterns to my eye. And it's not yet possible to say which is true. They are both, if you like, equally probable outlooks, in my opinion. Let's look shorter term at the Nasdaq. Nasdaq is a bit less extended than the S&P, to my mind anyway. I think that the Nasdaq could get to 19,150 without saying that it's too extended, and then we could see again this sort of correction and ABC correction down to 2021 all-time highs. You know, or perhaps it started. You know, maybe that was the local high, and we're going to see that, and then that, and then that. Who knows? But again, just a little bit cautious at the moment. And for me, this FOMC is critical because, as we've all seen, inflation's ticking back up a bit. And the question is whether the Fed actually does or says anything about that. I have a hard time believing the Fed's going to raise rates during an election cycle, but of course you never know. But what the market thinks the Fed is going to do about hiking, keeping flat, cutting, that's going to drive outcomes after FOMC. FOMC itself usually results in a big swinging around of the market, up, down, before settling on a direction. It's usually pretty hard to tell what that final direction will be until really the day after. So whatever the reaction is on Wednesday after the press conference, I'd hesitate to conclude that's the final market reaction. Generally speaking, you want to sit back and watch it for a day or two afterwards. Still the Dow. Here's the DIA. Dow on any measure to me looks bullish. Even on a base case, I think it can keep climbing. And if we were to look short term on the Dow and the YM futures, same argument really. It just looks bullish to me. So you could argue with some conviction, I think, that, well, since the overlap in holdings between the Dow and the S&P and the Nasdaq so strong these days, that if the Dow is moving up, so too are the other two. I think that's a pretty good argument, to be honest. So you could argue and that will be bullish for the other two indices. And then let's finally look at the Russell. Russell's looking bit sickly at the moment. In my view, the whole question is, can IWM hold over 200? If yes, then it can really start to move up. It peaked at 210 last week, sorry, 2 weeks ago, sold off last week, sold off this week so far. It's at 201 right now. This 200 is the key level. So I personally have a long TNA position. That's a 3 times long Russell ETF. If IWM drops below 200, then I shall be hedging that. For now, unhedged long. Let's look at the Russell futures. Have been looking pretty good until the last 3 days, and you can see that shape just starting to roll over, and it's possible that maybe that there was a wave 5 high. That's a valid wave 5 high for sure. It's above that wave 3. It's about 0.5 extension of the wave 1 plus 3 combined. So that could well have been a wave 5 high. Maybe now we are in an A, B, C type correction. That's definitely possible. So the thing for me again is just watch it. I don't really watch RTY as the trigger. I'm looking at IWM because this 200 level here has been just defining the top in the Russell since April 22. So we're nearly 2 years into this sideways channel now. So if it breaks 200 to the downside, then I personally should be hedging my TNA position using TZA. Okay, that's indices. Let's take a break. Let's take some questions and points, comments if we have any. Let's just make sure people's mics are on. They are. So if we can start questions. Paloma, you're up.
Yeah. Hi, Alex. Good
Hey, good evening.
evening. Just one question. I mean, yeah, everybody knows, we're not going to have a rate cut at all. But everybody also knows that we're going to have higher rates for longer. Because, the inflation numbers, they're not looking as good as they
Yep.
should be.
Yep.
But what I'm thinking is, higher inflation, higher interest rates for a longer time is definitely not good for small caps. And I am long the IWM,
Yep.
and I'm long at 200. So
Yeah.
I'm right there. I'm like
This is
hanging on to the
Well, it's a
cliff.
pretty sensible place to be long, to be honest, because if it drops below, that's a meaningful level. So I think it's a sensible place to be long, to be honest.
Yeah, but what happens, if we have longer interest, if we have longer, higher, not higher, high interest rates for longer, small caps are going to get hurt.
I'll tell you my answer. I don't know if this is correct or not, but I mean, where if you think where the cost of money is now, it's not high by historic standards. I mean, as you know, right? It's high by the standards of the last few years, but it's not historically high. It's a bit above where it has been for some parts of history, but money isn't expensive now compared to 20 years ago. I think if rates go up, if base rates go up, then we're going equities are going to feel some pain, right? No question. But if base rates stay where they are, and I wouldn't rule out rates coming down a bit, to be honest, mainly because it's an election year, then I think the Russell can still rise. I think because I think that it's really a question of demand for the stocks themselves as opposed to the economic conditions that the small caps find themselves in, I think. And why I say that is because if you look at what happened to tech in 22, demand for high beta tech stocks evaporated, even when the underlying companies were incredibly cash rich. So in other words, whilst it was true that if you were a loss-making software company in 2022, it would have been very expensive to raise any kind of cash finance, your stock got hammered even if you had plenty of money and you didn't need finance, and so the prevailing interest rate didn't matter. And so I think the question of demand for the stock is more important than what's the cost of capital for the underlying company. So to my mind, and I don't really have anything other than my opinion to support this, to be honest, if rates are flat or down a bit, I think all equities, all sensible equities, including the Russell 2000, can rise. If rates go up, yeah, I think everything's coming down. Um, a really, really good video I think is worth everyone watching if you follow the Russell is a Chivaco Capital video from 2 weeks ago. I think I posted this in the service. It was in one of the market notes either yesterday or maybe it was Friday. It must have been no, it must have been today. And they do a really good long range study of the Russell versus the S&P. And in short, the Russell has declined relative to the S&P for quite some time now. And so I think you can look at the chart that's on the screen right now and you can say, well, if things are bullish, then the Russell can moon and maybe there would be rotation from large caps into small caps because this thing hasn't broken out for 2 years. History says that's not likely. I thought it was a really good video. And so that sort of, it's changed my view a bit, which is if the Russell moves up, probably for myself, I'll take profits sooner rather than later, rather than waiting for, a sustained breakout here. We might get one, but just that decline of the Russell versus the S&P for a long period of time. So watch the video; it's really good. I'll post a link in chat later in case anyone missed it. Just gives me a bit less long-term confidence in that Russell. So that's my take, which is I'm a bit worried about it. I'm quite long it. And so I'm sort of ready to hedge short term if I need to, if that IWM drops below 200. If it moves up, though, I think I should be taking profits sooner rather than later. That's my take. And I'm sorry, I don't really have any evidence for you. It's just my opinion.
Mm-hmm. Okay, makes sense. I'll be watching the 200 level. Won't
Yeah.
take my eyes off the screen.
You can see that from the chart, right? It doesn't need any kind of genius to say like 200 is critical. If it drops below, I mean, look at it last year. Here's December 23. It peaks up over 200, and then it drops down to 186 into January before it bounces. Now, of course, the bullish sign is well, it didn't drop very far, and then it powered up through, and it hasn't yet dropped through 200. But that's the zone to watch. And as I say, I think being long at 200 is quite sensible, to be honest, because it's sort of black and white as to, well, is it above or below? So yeah, let's see.
Okay, thank you.
All right, welcome. Anyone else before we move on to single stocks? Okay, let me just check Slack. Hang on. No, okay, let's go. So let's move on and let's look at Apple and Adobe for a moment. Now, we've just started covering Apple, and the reason that we've started covering it is because everyone's convinced that it's all over for Apple. And my own view is I've been pretty bearish on the name for quite some time and been flat wrong. One of the reasons we haven't covered it is because I never felt able to call it very well. The company was not the stock. The company, as we can see here, was X growth, margins flat, innovation low, and yet the stock was on fire. And I couldn't ever really, get to grips with that, to be honest. However, the stock has been selling off. Generally bearish narrative on Apple, cancellation of the car project, all that. People saying that its best days are behind it, all of that. And this is at the same time when the fundamentals are turned up a bit. Now, they're not on fire, but they've been going backwards, and now they're not. So if we just look at the quarterly growth numbers. So the most recent peak growth was back in September 22 quarter. It's a September year end, I'm sure you know. So 8% growth then -5, -3, -1, -1. So going backwards. The December quarter, first quarter of their financial year, it puts in a 2% growth rate, which brings annualized growth or TTM growth to flat. Gross margin also ticked up just a little bit. So it's now a fair bit, materially higher. If you look back to the end of 2020, 39%, always mid to high 30s back to 2019. The reason it's higher, it's very simple, which is the increasing degree of services in the mix. Services are a higher gross margin product than selling phones or computers. EBITDA margins again ticked up, so 35% for the longest time, ticked up to 37. This is a trailing 12-month measure, so it doesn't move up or down quickly. So that it's moved up, 2 points in 2 quarters. That's meaningful. And then cash flow margins, we're back at pretty much, I think, I thought so, peak cash flow margins. And again, they ticked up 2 points in this quarter. If you also look at the net debt position, net cash position, so net cash got worse last quarter, but a lot better this quarter. So fundamentals look like they're in the early stages of improving, and yet the stock, hasn't. So let's just take a look at the chart here. So I'm long Apple. I don't have a huge position. I'm, plenty of it through TQQQ, but as a single name stock, I'd have a little bit, not much. But it sort of caught my eye as something with a negative narrative, but improving fundamentals. This is how I think the chart is. Now, this assumes that bull case logic in the S&P and the Nasdaq is true. In other words, this takes trade point 0 as the COVID lows. So we have a wave 1 up at the end of 21, early 22, a wave 2 down, not even a 0.5 wave 2 retrace, a very shallow wave 2. Apple was a really great thing to own in 22. Actually, it barely moved compared to the Nasdaq and the S&P. We then get this wave 3 up, and so this sideways zone here, which has been in this zone between, let's call it 195 and 167. It's been in that zone since April 2023, so about a year now. A pretty high volume, right? So this clock here starts in April 22, and the reason it starts there is because that's the point at which institutions were beginning to accumulate stocks. As soon as April in the bear market, you see volume spike with what looks like institutional buying. And if you look at the volumes up here, again, between about 170, let's call it, and 195, let's call it, they're pretty hefty for Apple. Now, this isn't selling up to or after that prior all-time high, because the clock doesn't start till here. This is, and it's also not selling of that August short-term peak in 22. This is high volume up here. So the question is that distribution? It could be, right? It could be sideways at the highs. And in fact, this is institutions dumping Apple and getting ready to run. It definitely could be that. Hence the stop zone here, because if institutions are dumping, when they're finished, this thing will drop like a stone. Hence a stop zone here that starts at 165. But it could be accumulation in recognition of, these fundamentals improving, in recognition of the idea that, new products like the Vision Pro headset, I don't know if that particular product will take off, but that's a new category of product I've got into. In recognition of the fact that Jay made a comment that caught my eye in chat last week. He said, well, Apple owns and controls a large portion of devices through which AI-based services will be delivered. So there's a talk of the deal with Google today. So I don't know, but I do see fundamentals improving, negative narrative around the stock, and yet this sideways pattern. So me personally, Apple isn't a hill I would die on, but I think there's a chance it can surprise to the upside. I think if you're interested in investing in it, then there's a pretty clear, sensible stop level around that 165 or below. It's held as support back here in October 23, and again here in March this year. And if this turns out to be accumulation, I think there can be some nice upside here. So that's Apple. Let's do Adobe. Adobe, if you haven't seen it, have a look at the earnings note in the service. I mean, Adobe is a machine of a business, and unusually in software and enterprise software, what the company has done just brilliantly is survive any number of paradigm shifts that really should have finished the company off. So for those of you who are old like me, the company started out as essentially it developed printer interface software. So when printing anything from a computer was difficult, they developed some software which made it a bit easier. And then that became commoditized. They moved into desktop publishing, as it was called at the time. This stuff is all super easy now, but it wasn't 20, 25 years ago. As desktop publishing became commoditized as they lost the race to Quark Express, which was an important company at the time and product at the time. They moved into imaging. Photoshop, which I hadn't realized they paid $35 million for, that's all, from its original founders. Big successful story for them. As static imaging was replaced by dynamic internet imaging, they bought Macromedia, who wrote Flash. As PDFs, which originally was just a way to share documents between PCs and Apples and Linux devices, as they became commoditized, they moved them into live documents. So my point is that in enterprise software, there's hardly any companies ever that survive even one paradigm shift, and to have survived and prospered from 4 or 5 is an incredibly skillful thing for the companies to do. The company just had its first antitrust setback in the proposed acquisition of Figma. Now, Figma is a tool set business. It helps develop electronic products, by which I mean software products and soft delivered products. It has some imaging capacity. It competes with Photoshop to a degree, and it's almost pre-revenue startup. And nonetheless, Adobe had agreed to acquire it for $20 billion. And I personally thought that was a great idea. The stock dived when the deal was announced, and the deal was nixed by Adobe and Figma earlier this year because they couldn't find a way around antitrust concerns. Now, first of all, I'd say it's a lobbying failure by Adobe. They should have seen this coming and didn't, obviously. They also agreed to pay $1 billion in cash breakup fee to Figma if the deal didn't go through, which they have had to pay. And you can see in this quarter, I didn't highlight it in numbers, but EBITDA and cash flow is really low this quarter because there is $1 billion missing. And there is $1 billion missing from cash because they just had to pay it to Figma. So if you're a Figma shareholder, on one hand, you're crying into your beer about the lack of your sale, but on the other hand, you do have $1 billion reasons to cheer up a little bit. I think it's a real shame for Adobe because this is a company that has consistently jumped the shark, as it were, and I think it's a real failure of their lobbying and M&A capacity to do it this time. So I'm not an Adobe shareholder, but I'd be a bit worried if I was. On fundamentals, really good. Growth holding up nicely. TTM growth ticking up a bit. Gross margins, great. EBITDA margins would be fine if it wasn't for that missing $1 billion. Same about cash flow. And the balance sheet also perfectly fine. We look at the stock chart. Nice bounce, technical bounce. So that's Airbnb. Let's just look at the shorter term chart here. Okay, so this is a really nice chart as follows. So this chart starts at the bear market low, September 22. We get a wave 1 up into February 23. A 61.8 retrace wave 2 low into February 23, a 1.618 perfect wave 3 extension into June 23, a small sell-off, a 236 retrace into the June 23 lows, and then wave 5 that peaks pretty much exactly where it should, just into that 61.8 to 78.6 zone. So technically, this is perfect. I think a beauty. Are we going to get an ABC correction now? Look at how brutal these things are. Okay, so this is why ABCs are so hard to play in my view. So you get an A-leg sell-off, okay? It's dropped from 633 to 562, not the end of the world. Along comes the B-leg and you think, aha, well, that's fine. We're going up again. And look, you would say that's not really a wave 5 high because, well, we're in a bull market and it only just got over that 61.8 extension. And surely because we're in this big bull market, the S&P's on fire, the Nasdaq's on fire, then the 5 high should be, at least up here and maybe up here. And here comes this B wave and you think, okay, I thought so, off we go. Oops, because it actually clears just a bit more than that wave 5 high, which is common for these B waves. And then dumps, brutal dump. And this C leg down is about 2x the A leg. That's an unusually brutal one. So 633 down to 563, so call it $70. And here we have 637 down to 486. So what's that, about $150? So that's a really, really brutal C wave. But look where it finds support. When a wave 5 sells off, you often find that the ABC correction sheds all the value created in that wave 5. And this did it almost to the dollar. Look, your wave 4 low was here, 472, and the C wave, if this holds low, was 483. And so this support zone here, which dates back to the wave 4 low here, so far has held. There's a big, nice move up in Adobe today, 4 points up. So I don't know how this is going to do. Bit worried about it, about their ability to keep doing the thing that's made them successful. Technically, this looks like it's at support. Not going to play this personally, but certainly if you were, then what you might look for is something like this, which is a lower risk way to play these sorts of things, is to look for a wave 1 up and a 2 down and then a 3, 4, 5. And so at the point where this move up finishes and you get a retrace of it, which you would expect to be, a meaningful retrace, let's call it, somewhere in the 61.8 zone. So were Adobe to move up a bit more and then sell off back down to 500 and hold there, then you might think that's a good way to take a bullish position in it. So I worry about Adobe. I don't own it personally. I'm not going to take a position. But I would say against that fundamental worry, then technically, this chart's a thing of beauty. And why that's important is because if a chart trades to textbook institutional patterns, it's probably going to continue to do so. And therefore, because that C wave low looks like it sort of should have held there and has, if we start to see a 1 up and a 2 down, then maybe we start to build some strength going forward as well. So I just wanted to highlight that. I think it's pretty interesting. Company's in a pretty interesting place right now. Let's do Meta. So had some questions from Paloma and others about Meta. Just 1 second. Let's get this so we can see it properly. Okay, so Meta performance on fundamentals, fantastic. So most recent quarter, 25% growth in the quarter. It's accelerated every single quarter since the start of 2023. And how? TTM growth rate now 16%, guiding up again, guiding for a 25% growth quarter for the March quarter this year. That will take TTM growth to 21%, so a big step up again. Gross margin holding nicely at 81%. EBITDA margin fantastic, 53%, which is the highest it's been since the end of 2021. Cash flow margins, 36%, not quite back to all-time highs, but not far off. Balance sheet, $47 billion of net cash, even if you exclude their equity investments. And just all in all on fire. Now, the stock, has been moving up like there's no tomorrow. Zuckerberg has been selling, which I'm not directly a Meta shareholder. I sold out too soon. But if I was a shareholder, I'd be a little bit concerned about that. He has a great track record for selling at the highs. Did it really well in 2021. Stock right now on valuation, it's still not particularly expensive. So it troughed out at 7.5 times trading cash flow in 22. It's now at 25 times trading cash flow. That's about a bit less than half what Nvidia will cost you. So Facebook Meta platforms never seems expensive to me. So I think you have to go by the chart, not the fundamentals. Chart, obviously, incredibly bullish performance so far. But if you zoom out a bit, this is from the post-IPO lows to the 2021 highs, a perfect 78.6 retrace down to the bear market lows. And I mean, it's been only up since then, so it's hard to believe that's going to continue. But if you can stomach some volatility in this, I don't really see why it couldn't get to 676 or thereabouts, which would only be a 1.618 extension of that. Now, it's probably not going to get there tomorrow, and it might sell off a bit first, but the company's in really good shape. You've got growth accelerating, margins up, balance sheet up, everything's looking good. And the only negative I can see is Zuckerberg selling, which would concern me if I was a Meta shareholder. We look at a slightly shorter term chart than this, then it's pretty much what we looked at last week, I think. So again, look, it's showing that sort of topping pattern that we see in the indices. There's a gap here. So, could we see a wave 4 down here to close that gap there, which would also be the 0.5 retrace for this wave 3 up? Sure. So you could see some volatility along the way, but if we do, then I think we probably see another move up. So depending on time frame, I would probably be bullish on Meta. Near term, could see some weakness for sure, but fundamentals are just terrific and improving. So that's Meta. Before we do semiconductors, any further questions? We're going to go on to do Nvidia and SMH and SOXX and SOXL in a minute. Any more questions? Paloma.
Yeah, I sold Meta.
Hey. Well, look, you can't criticize yourself for selling at a 5.618 extension. So.
I sold it at the close. I just couldn't resist it. I was up 40%. I said, okay,
well,
I'll take the cash and I'll buy back when it comes down. So
yeah, or if it keeps going up, right? You can always buy back in. That's the point. That's the beauty of public stock.
Yeah. The only thing was the TikTok story, which is all over the place, and that actually I think would I didn't know about the Zuckerberg was selling. I had no idea. But the TikTok story could be positive for Meta, definitely.
Yeah, for sure it could. Yeah, for sure it could. So I mean, just looking at the chart, my guess would be it sells off a bit and then comes back. That'd be my highly sophisticated analysis. But 40%, fantastic. No one ever got poor doing that, right?
Where would you put the buy? I know you can't answer that question. 410, something like that.
Yeah, I mean, that'd be a cautious level, wouldn't it? I'll tell you something I've noticed recently. Again, I don't have any hard evidence of this, but just given I watch charts all day long, is I've seen a tendency for things to not quite hit the fib levels that they should, and I think that's probably deliberate, right? I think that's probably the fact that institutions know that people watch the fib levels and just don't quite let these things hit the levels they should do. So that means I've seen things falling a bit short of a fib level on the upside and not quite selling off as much as you would think on the downside. So yeah, 410, I can see the logic for sure. If Meta falls to, if any of these corrections happen, right? So if, let's go back to the indices for a second. If SPY drops, hang on, sorry, wrong chart. If SPY drops to, 4,800, then people are going to be screaming and saying it's the end of the world and the rest of it. And it won't be. It'll just be like a minor sell-off. But you watch, there will be just fear everywhere. And so if the indices sell off a bit, and it is only a bit, then Meta will probably sell off a bit as well. It's a major component of the Nasdaq. Just go to the short-term chart. Sorry. There we go. So if the S&P drops from where it is to 4,800, could Meta drop to 410? Sure. Is it a disaster? No. It's just we've had this colossally huge run from the bear market lows. That's going to sell off at some point. So yeah, I can see a logic for 410. Equally, don't if you want back in and it only sells off a little bit, you might have to be prepared just to go higher. I mean, the thing I personally have just been lightening up a bit on some of these things. You've seen that from trade alerts. I'm sort of waiting for FOMC, and I'm waiting to see if we get one of those corrections like July to October last year, which, you know, people were saying, oh, the bull market's over and it's all the end of the world and the rest of it. And I didn't sell as much or hedge as much as I should have done in that July to October. What I did do well was basically go very, 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 very long in October and held on for dear life. And that did just great for me. So just personally waiting to see if we get that sort of correction again, because we sort of due it, and you can sort of see these topping patterns in a whole bunch of things. So for me, I just a bit careful in deploying capital at the moment, personally. So we'll see.
Thank you.
Welcome. Right, let's do semiconductors, unless we have any other questions. No. Okay, let's go. Let's look at everyone's favorite stock, Nvidia. So we have the Nvidia GTC conference tomorrow, which has been hyped through the roof, so everyone knows. Let's look at Nvidia on the weekly. So Nvidia on the weekly is not particularly extended. You know, this is the stock moved up above the 2.236 extension of this prior wave one up. This is on a weekly chart stretching back a couple of years. What's that, about 4 or 5 years now? So purely on technicals, there's absolutely no reason, in my opinion, why Nvidia can't reach, you know, 1370, which is the 3.618 extension. This is a highly volatile stock, and so big extension should be no surprise. It's also, like the meta chart, just been only up really since the bear market lows, and so you would expect at least some cooling off, which we did see between May last year and January this year. Sort of went sideways really, and you can see this big accumulation zone. I'll just move this markup zone out of the way. This big accumulation zone here, well, this was basically late bulls. You know, they should have bought down here, but they didn't. This is late money buying in anticipation of the big move up. And so there's no technical reason to my mind why it can't reach quite a bit higher from here. On fundamentals, it really remains not expensive at all. You know, on a cash flow multiple, it's really not expensive. The AI spending boom it's a real thing. I don't see why Nvidia's growth can't continue at these levels, maybe even accelerate, and margins ought to continue to tick up. They don't really have any competition. AMD is a distant second. I'm pretty bullish on Nvidia. I think it's just one of those times where you get these runaway names, and it's a real company. You know, it's not a meme stock. It's not a sort of fantasy football thing with no reality underneath it. It's a real company producing a ton of cash flow. It's pretty bullish on it. We'll see what happens tomorrow and in the reaction to their conference. And it could be that this has just been all hyped up ahead of time and it'll be a sell the news event. I don't know. But sitting back over the next year or so, I'm pretty bullish on this name personally. So we'll see how it goes. There's not really any shorter term technical analysis you can much do on Nvidia. It's kind of an only up chart. You know, where will the next wave end? Well, you know, perhaps the 4.618 extension of this move up since the May lows, maybe we get a sell off at that point. I don't know. I mean, you would expect some volatility, you would expect some down before it continued up. I don't know. You could argue this range here, this is consolidation, bull flag forming, all that. Don't know. Personally, I'm pretty patient on it, but I do think it can. I do think it can reach higher. I do not think it's expensive on fundamentals at all. Let's do the semiconductor ETFs. So we have a couple of questions on SMH. So let's do that. Second, Transpider updates.
Alex, sorry, you've been buying Nvidia today, right?
Yeah, I have.
Yeah.
Which is sort of in anticipation of, you know, if that event does turn out to be a bullish thing, great. There's some short-term gains, you know, and if not, well, I'm happy just to sit back, and if it sells off a bit, I'm happy to be patient. But there's a chance I think we can get a positive response on that event, so you know I don't mind trying.
Okay, good.
And also because I don't think it's expensive, so even if it sells off a bit, I think, well, that's a fantastic company that I'm holding, and if the shares sell off a bit, I can live with that. Right, SMH. Okay, this again, on all these ETFs and all these big stocks, I keep coming back to this bull versus base case thing. Okay, if we're in a bull cycle that started in the COVID lows, SMH has got plenty to run yet, because it will be this purple dashed waveform. The lows at 54, 21, 22 highs at 160, sell off down to 81, and then we're in this big wave 3 up, which should run to at least 264 from 218, and probably because it's semis, it will probably run higher, maybe 300 and beyond. So if we're in this bull cycle, SMH, and for that matter, SOXX, same thing, same technical pattern, has got plenty to run. We are, 2/3 through this wave 3, maybe only half the way through this wave 3. If though we're in a cycle that started at the end of 2018, we're in a wave 5 high, then this thing's going to sell off soon. But look, there is some evidence here that says that base case argument is just wrong. Because if this was a wave 5, right, if this was a base case situation, well, it should really have sold off either, this is back to SMH, by 178, or really at the most by 203, and it hasn't. It pushed up to a high of 240 nearly, and now we're back down at 218, and that's a really, really big wave 5, and I have a hard time believing that's a wave 5. It looks and feels more like a wave 3. So SMH, because semis have led the market lately, is a good, I would say, piece of evidence that says we're in a bull, a bull case cycle. That's just my opinion. Again, I don't have any evidence for that. SOXX, the same. So if you were to draw a pattern that started at the 2018 lows, then it would look like that. I'll change the labels on it. 1, 2, 3, 4, 5. Let's just reframe the labels. Then we'd be in this wave 5 up now, and just to measure it for 1 second. So to measure these wave 5s, you go from the bottom of the wave 1, top of the wave 3, start of the wave 4 low. You see, and already we'd be past 100% extension wave 5 if this was a base case. And so I just have a hard time believing that that's what we're in. It's possible, but semis have led the market. They're the leading indicator on the equity indices, and they look for all the world that they're in a wave 3. So I could be wrong. It could all dump tomorrow. One has to be ready for that. But I think they've got further to run. And if SOXX and if SMH and Nvidia have further to run, then so too does the Nasdaq and the S&P and the Dow. We look at SOXL. This is the leverage version, as you know. It's not really close to an all-time high yet. It put in what looks to me like a wave 3 high at the 200% extension. So it looks like this is the bear market low. This is the leveraged ETF. So these are a bit tricky to chart. It's better to look at the underlying, in my opinion, but it's a good sense check. So wave 1 up here, 61.8, wave 2 down there into the October 23 lows. Probably that's a wave 3 high, a bit shy of that 200% extension. And then probably we're into a wave 4 low that could drop to 28 from 42. That would still be a bullish pattern, but probably won't. It'll probably be a bit less before, in my opinion, and you move higher. And that wave 5, could take SOXL to new all-time highs above 74. And again, look at the angle of that run up. Look at the price movement. That doesn't feel like a wave 5 to me. That looks like a wave 3. So I could be horribly wrong, which is why I keep saying there isn't really any hard evidence as to bear versus base case, but it does look and feel like a 3, not a 5. And if that's a 3 and not a 5, then that's a 3 and not a 5, and that's a 3 and not a 5, and in fact, that's a 3 and not a 5. And back to the S&P, that's a 3 and not a 5. And so the strongest evidence, in my opinion, as to why we might be in a bull case on the Nasdaq and everything else is semiconductors, which just don't feel like they're in the final stages of a bull market, to me at least. News on semiconductors, by the way, starting probably next week, we'll add the following stocks to coverage, which is Broadcom, AVGO, Micron, MU, Cadence, CDNS, which is Design Software Business, and Synopsys, SNPS. So we'll ease into those starting from next week. But by the time they all publish earnings for the March quarter, we'll be covering those in full. So that will start next week. Okay, well, look, that's all I had personally today. Anyone has any more questions, points, comments, anything, now's a great time to shout, either shout out loud or post in Slack, whatever you want. Or anything you didn't think of during the session, then obviously reach out afterwards, either comments to the YouTube video or Slack or anything else. Failing that, thanks as always for attending. Video will be live in a couple of hours. Paloma, you have any final ones? No. Okay, great. Well, we'll finish up for the day. Thanks again, everyone.
Just last one.
Yeah, go for it.
This is just FOMC. This is just FOMC.
Yeah.
There's so many outcomes, and the more you read, the more confused you are.
Correct.
What can Powell say? I mean, I'm just completely lost here with Powell. I mean,
honestly, this is what I think about FOMC. I think that large market players know what they're going to do. Okay, and an FOMC is just an excuse. I think they already know whether this is going to be we're going to sell off back down to somewhere to the 2021 highs to scare the hell out of everyone. Because don't forget, if you've been a member of this service, we were shouting buy, right back at this service started in early 23 and our Growth Investor Pro service before that, since the middle of 2022, we've been shouting buy. And so if you took any notice of that whatsoever, then you've been buying or you've been long for 18 months now. But that's not true of most people. Most people have only just started to buy stuff, and therefore they'll scare easily. And so if you're a large account player, and if you too were buying in the second half of 22 as the sensible ones were, then you're sitting on some fat gains right now. And can you afford to take a paper hit over the course of the next 2 or 3 months if the market sells off? Sure you can, not least because you're nowhere close to end of year valuation reviews, bonus reviews, all that. So now is a great time to inflict some pain. So my own view on FOMC is there is a plan already set, and it kind of doesn't matter what Powell says. The market's going to do what the market's going to do. This chart, this ES chart, SPX chart, this looks a bit queasy to me. I'm sort of expecting a bit of a dump, and I'll be surprised if we don't get one. I haven't hedged all these things yet. I've taken some capital out, haven't shorted, because that's been a consistent, again, the only thing you could have done wrong in the last 18 months is to be too careful. So I don't want to make that mistake, but I'm sort of ready for a sell-off. And I think the plan is already set. And I think what Powell says is incidental. I don't think Powell's going to raise rates. It's an election year. I don't think he's going to do a hard cut because inflation's on the rise. I think it's going to be a sort of a do nothing, talk a bit tough, all that. But I think the plan's already set. So to me, I sort of feel like, let's just see what's going to happen. Let's get to it already and see what's going to happen and then react. I don't really think it's about the words that Powell says. Again, if he raises rates, game changer, all different. But if he's going to do that, Nick Timiraos at the Wall Street Journal will tell you. Right? You will see the tweet. If you think back to 22, there was a surprise rate hike. I can't remember which FOMC it was. I think it was Q2. And there was a panicky tweet from the Wall Street Journal about an hour or 2 hours before they raised rates. And it was basically a panicky bearish tweet. And then the market dumped on the tweet. And they'd already sold by the time the rate rise was announced. And so if there's anything panicky, probably Timiraos at the Wall Street Journal, if you're watching, will tell you. That's the thing to watch. Anything panicky from Timiraos, that's a bearish sign. But
what's his name again? Sorry, I'm gonna connect with his
on Twitter. Timiraos, Nick Timiraos, Timiraos. I'll post his Twitter handle in the chat later, and subscribe to him. So set up for alerts, because anything he tweets is there for a reason. Right? This is, quasi-official commentary from the Fed. It's
Okay.
there. I'm not joking, right? I mean, this isn't like cynical conspiracy theory for me. I have plenty of that, but this isn't some of it. Just go back and check the tweets, and in particular, look at they did a 75 bips raise. I think it was the June FOMC in 22 when they've been saying they were going to do a 50 bips. They did a 75 bips, and an hour before or half an hour before, Tim Morales basically tweeted, "Could be worse." The market dumped, and then it double dumped after the announcement. But anyone who was watching got out first. And he has form for this. So watch him on Twitter, set alerts. If he tweets something, read it and think about what he's trying to say.
Okay, if you don't mind posting it, and also the article you mentioned about the video, I can't remember, of the Russell versus the S&P
Oh yeah,
500.
yeah, yeah. I'll post that afterwards. Yeah, yeah. I think
Okay,
it's in chat somewhere, but I'll post both afterwards. Abby's just put that Tim Morales Twitter account in chat. So have a look in chat, you'll find it right now.
okay. Thank you very, very much.
Thanks everyone. Talk to you all soon.